Revlon stock is up 53% today. The reason for this is the company is avoiding bankruptcy by refinancing $343 million of bonds that are due this month. Let's look at this company a little closer to figure out whether it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Revlon stock by analyzing their financial statements and dissecting their financial ratios to determine if the stock is a buy or a sell. Revlon develops, manufactures, and markets cosmetics, skincare, fragrance, and personal care products. You can find Revlon products in 150 countries. The company was started in 1932. Let's get started with the model. This is a small cap company, market cap $496 million. They're trading at $9.31 a share, and they have 53 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company had positive free cash flow in 2016, but negative in 2017, 18, and 19. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have negative net income every year. Revenue is the sales for the company, and it's pretty steady. It goes from $2.3 billion in 2016 to $2.4 billion in 2019. This is the company's income statement. The top of the income statement is revenue, the sales for the company. And in 2019, it was $2.4 billion. And their cost of revenue is $1 billion. These are the expenses that are directly related to making the company's products. So their gross profit is a difference between revenue and cost of revenue, $1.4 billion. But they have high operating expenses, $1.3 billion. So they don't have much operating income, only $50 million. In 2018, it was negative. The company did a decent job at cutting expenses, so its operating expense was much lower than in 2018. Below operating income is the interest the company pays on its debt, and you can see that's $211 million. So they pay more in debt than they receive on their operational business. So that's why they have a negative net income every year. The company has 4 operating segments: Revlon, Elizabeth Arden, Portfolio, and Fragrances. This column is the 2019 revenue for those 4 segments, and this is the 2018 revenue. They also show the profit for 2019 and 2018. So you can see revenue decreased in every segment except for Elizabeth Arden. But for their Portfolio segment, revenue decreased, but profit increased. So they did a really good job at cutting expenses in that segment. Same thing with Fragrances. Revenue decreased $511 million to $453 million. But the profit increased from $76 million to $82 million, so they're becoming more efficient. This is their revenue in 2019, but it's broken out by segment, and within each segment, it's broken out by North America and international. So if you look at each line item, the only one that increased was their international Elizabeth Arden segment. That went from $354 million to $400 million. This is their statement of cash flows, and operating cash flow is a better indicator of a company's financial health than net income. And they do have negative operating cash flow each year except in 2016. The way you calculate operating cash flow is you take the net income, then you add back the non-cash items from the income statement. The only main non-cash item they had was depreciation. You also adjust for changes in working capital. And the way you calculate free cash flow is you take operating cash flow minus capital expenditures. So they do have some CapEx each year. It's not too large. And the result of that is free cash flow, and that's negative every year except 2016. The company is really trying to focus on managing their expenses, cutting their cost, reducing their debt. Let's look at a capital structure. $3.2 billion of debt, negative $1.2 billion of equity. If a company has negative equity, that means liabilities are greater than assets. And they pay 6.15% interest on their debt. And they're 100% debt since they have negative equity. And their weighted average cost of capital is 6.15%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. we get a value of the company of $348 million. We divide that by 53 million shares, and we get a calculated stock price of $6.52. They're trading at $9.31, so they're trading at a 43% premium. It's a sell according to the model. Simply, Wall Street does not have a valuation for this company because there's not many analysts who value this stock. So you can see the stock was trading much higher, about $40 5 years ago, but it's been dropping little by little every year. It's at a really low point because investors felt this company may file bankruptcy, especially during COVID. But there is a resurgence today because the company may be able to refinance some of its debt. If you invested $10,000 in this company 10 years ago, you'd have $5,700 today. That's a 43% loss. And this company doesn't pay a dividend because it doesn't have any extra money to give out to its shareholders. These are some of the highlights from the company's annual report. 2019 operating income improved by $146 million compared to 2018. This is mainly due to operational efficiencies. Their e-commerce business grew 49% year over year, and it's almost 10% of their net sales. Business in China grew 70%. And the biggest highlight of the company is Elizabeth Arden. The net sales grew 9% and their profit grew 54%. This was in the news today. The company plans to refinance $343 million of bonds ahead of its November 16th default deadline. But this move has angered bondholders because the company will only give 32 cents on the dollar, and it's unable to find the holders of $90 million of bonds. If Revlon is unable to find the bondholders, then those bondholders receive 100% of their bond value, the entire $90 million. It is normal to not be able to locate some bondholders, but usually the percentage of mystery bondholders is between 3 and 5%. Since they have 90 million of missing bondholders, and $343 million of bonds, that's 26%, a lot higher than 3 to 5%. Revlon has many customers: Walmart, CVS, Target, Kohl's, Walgreens, TJ Maxx, and many other big box retailers, and of course they have many small boutique retailers. But none of these companies are under any obligation to continue purchasing products from Revlon. Its largest customer is Walmart, which makes up 15% of its sales. It's good to remember that a company's financial performance is not 100% correlated to the changes in the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers for Revlon. The stock price will go down if there are more sellers than buyers. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest things to do. In the short run, no one can predict the stock market. But if you invest in solid companies with good fundamentals and hold long term, you should be better off than most investors. The reason I like focusing on financials is because all the information is there. If you listen to others, they can spin their narrative to make the company look great or look terrible. Let's look at their financial ratios. The average PE is 16.2. The median is 14.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. We can't look at this ratio. Average price of sales is 4.9. The median is 2.0. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.2, so they're doing much better than the median and average. They just need to convert more sales to profit. The average price to book is 4.6. The median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They have negative equity, so they have a negative price to book value. Equity is assets minus liabilities on a balance sheet. The average interest coverage ratio is 12.4. The median is 3.9. Interest coverage ratio is EBIT over interest expense, so they can only cover 1/3 of their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE is 12%. The median is 12%, but they have negative net income and negative equity, so we can't look at the ROE. The average current ratio is 1.8. The median is 1.3. Current ratio is current assets over current liabilities. They're at 1.2, so they can cover their current liabilities. Their current assets are $104 million of cash, $463 million of receivables, $448 million of inventory, and a couple other smaller items. Cash is the best asset, so only 10% of their current assets are cash. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. So to summarize, I have them trading at a 43% premium. The ratios and financials look pretty weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.